Hey everyone, it's been a while, but I want to get back to my BPA project. So, in this video, I'll be talking about Chapter 6, Signal Bars, Other Types. Chapter 5 was about reversal bars. In this chapter, I'll talk about all the different ways to enter a trade and all the different types of bars that potentially have an imbalance of buyers or sellers above or below the bar. So, um, this has a lot of variety of different ways to enter a trade. So the first thing, as a reminder, is that a signal bar is just a setup bar that triggers. So any bar can technically become a signal bar if it triggers above or below the bar, but that doesn't mean that it's worth taking. And all signal bars are meaningless without supporting price action that indicates that the breakout of the bar will likely go far enough for at least a scalp, so at least some kind of profitable trade. The first type of signal bar we'll be talking about is the trend bar. A trend bar is one of the most important signal bars, and it's one of the highest probability signals because it shows proof that your side owned the bar in your desired direction. And ideally, the bar has a small tail or no tail above and below the bar. So here we have a bear trend, multiple pullbacks to the moving average. And you can see bar 7 here, the first arrow, bar 30, the second arrow, and bar 51, the third arrow, are all bear trend bars. They're showing proof that at the moving average, sellers came in and created or owned the full 5-minute bar, closing it near its low. So very small tails above and below, pretty clean trend bars. Here as well, we pulled back to the moving average. We have a bear trend bar here on 26, but it's coming after 4 bull bars. This is a second entry on 28, but tail on the bottom. 30 is proof that the bears own the entire bar, accelerating down from the moving average. So bears will sell below bar 30. Another pullback to the moving average here on bar 50. Instead of selling below 50, a lot of bears will wait for a bear trend bar, and that happened on 51, and bears will start selling below 51. So it's proof that the bears own the entire bar, and that increases the probability for the with trend direction. So trend bars are especially useful during the spike phase of a trend. So here we have the spike phase of the trend. We have multiple trend bars closing near their lows with small tails above. A trader can sell any of these trend bars, expecting that the spike will continue. So first I'll talk about how Al describes the trigger of that trend bar, and then I'll talk about this chart specifically. So one way to enter after a trend bar is to simply sell out the market. As soon as 6 closes near its low, it's a bear trend bar, it's a breakout. Traders can sell the close of 6, they can sell the close of 7, and by sell the close, in the most literal sense, it's as soon as the bar closes, you sell the market. So sell the market after 6 closes, sell the market after 7 closes, sell the market after 8 closes, same for 9, same for 10. Now some other traders won't sell out the market because they might get slippage and they might get filled a few ticks lower. So another way that Al recommends that traders can enter with these trend bars is as soon as the bar closes, they can place a limit order to sell at the close of the prior bar. So when 6 closes, they can place a limit order to sell at the 6 close. And you can see 7, the tail went above the 6 close and then reversed back down, so they would have been filled. Again, when 7 closes, traders can place a limit order to sell the 7 close, and you can see this tail on 8 went above the 7 close, so the traders will be filled there. And the same goes all the way down. The third way that a trader can trade these trend bars and enter in the direction of the trend is to place a stop order below the bar. So when 6 closes, they don't sell the market, they don't sell with a limit order, but they place an order to sell below the bar. That is the highest probability form of an entry for this type of situation because the bar has to trigger. So if you look at every small tail below the bar as a tiny flag on a lower time frame, it's a small pullback. So by placing a stop order below the bar, you're saying I only want to get in if this is actually a tiny bear flag and then it breaks below. And so your probability is going to be higher because you're waiting for it to break below a tiny structure, and you keep doing that. And then here you can see below bar 10, if you sold the market at the 10 close, you would have been filled. If you sold with a limit order at the 10 close, you would have been filled. But if you place a stop order below 10, the market never traded below 10. So in the former two cases, bears who sold the market and sold with a limit order, they would have to manage the trade. They'd have to scale in higher or sit through a pullback, which increases the risk of the trade. Whereas a trader using stop orders below the bar, they would not have to sit through a pullback. So they lose a couple ticks on every trade because they're entering lower, but their probability is higher because they won't get filled unless the market is strong and triggers below the prior bar. And so here, the reason that this arrow is white is because it's a discretionary, cautious sell. So it's still a bear trend bar in the direction of the trend, but the highest probability form of an entry with a trend bar is during the spike phase of a trend. And here we're in the spike phase. We have consecutive bear bars. It's a sell to close sell off. Whereas here, it's coming after a tight trading range. So now we're waiting for a breakout out of a range. This could be a failed breakout of a tight trading range leading to a final flag. So it might be okay to sell here, but it doesn't meet the criteria of the high probability entries in the spike phase of a trend. This is now betting on a breakout of a tight trading range. And so a trader has to be more cautious selling here. Here's a bull scenario. So here we have bull trend bar closing on its high and potential trend from the open spike phase of a bull trend. So the three ways to enter here are buy at the market when this bar closes, buy with a limit order at this close, or buy above the bar. And so here, bulls buy here, bulls can buy here. They can buy above 6, they can buy above 8. Now, once we get up here, I have it as white because it's a bigger bar and it's coming after the first pause. So now it's not as clearly in the spike phase. We have a pause. It could be a potential 1 bar final flag. So traders will be more cautious. You can see that in a lot of these situations. For example, here, bears who sold that, if they're being cautious, when they see 17 with a bull doji, if they're disappointed, they can exit at their entry. And you can see a lot of bears did that here and the market reversed up. So the cautious entry means that if you're disappointed quickly, you can exit quickly. And so when they got the doji instead of a big bear bar, a lot of bears exited. Same situation here. Some bulls did buy above that cautiously. And when they got the bear doji, they thought, that's not what I wanted. And on 11, you can see that it went back above bar 9 and then reversed down for a small pullback. So after the first pullback, when there's a possibility of a final flag and a bigger bar, a lot of traders will be more cautious with their buys. Now here on bar 15, it's a bull bar closing on its high, but again, it's coming after now a bigger pullback and possible final flag. So again, traders will be more cautious when buying up here. Here is a buy the close rally. So bulls can enter in any way that they'd like. 67, 68, 70, 71. Now 72 is a doji, and that could lead to, or it could indicate that we're close to the end of the buy the close rally. And then 73, we get a bigger bar. So a possible climax late in a buy the close rally. That I have as red because it's not a good buy. I wouldn't say it's a discretionary buy either. It's at the measured move target and it's a bigger bar late in a bull trend, late in a buy the close rally. So probably going to pull back. And I don't think that's a wise buy above there. Here's a similar situation. We have a tight, small pullback, bull trend here. We get trend bar. Bulls can buy that. Bulls can buy above 37, 38, 39. And when I'm saying above, they can buy above. They can buy above. They can also buy the close by buying the market or buying with a limit order at the close of the bar. Then here we have a doji late in a buy the close rally. It could signal the end of the buy the close rally. 43 is a bigger bar, so I don't think that's a good buy. Now you can see here is a good example that we did not go above 43. So a bull who is not being cautious because of the doji and they just want to buy every bull bar. Bulls who bought the 43 close, when 43 closed, when they bought the market, they would be filled here and would have to sit through a pullback. Bulls who bought with a limit order at the 43 close, they would have been filled here and they'd have to sit through a pullback. But the bulls who buy above 43, they didn't get filled, it didn't trigger, and so they don't have to sit through a pullback. So on every one of these bars, when they buy above, they're losing a few ticks by trading higher, but they get that increased probability and they don't have to exit. They don't have to sit through a pullback here. So what to watch out for? Trend bars are obvious signal bars for with trend entries, but they can also be used as reversal entries. So what does that mean? It means when you have a big bear trend bar, it might be seen as a sign of a reversal. So not to sell in a bear trend, but actually start looking and getting ready to buy. So although most large trend bars that are with trend are strong signal bars for the bear case, if the bar is unusually large and is coming 10 or more bars into a trend, it often represents climactic exhaustion and it'll often correct for 10 bars and 2 legs and can sometimes lead to a reversal. At the very least, it indicates that a trading range is likely to come soon. And so advanced aggressive traders can start buying, and beginners can wait for more information, but at the very least, traders should start to become reluctant to trade with trend after seeing bigger bars late in a trend. So here, this bar, it is technically a breakout. It's a bear trend bar in a bear trend, but it's coming after multiple climaxes. It's not in the bear spike phase, which is here. Selling below here, selling below here, selling below here. And this is actually another good example. Bears who tried to sell below this bar, they didn't get filled. And so they didn't have to sit through a pullback. But bears who sold to close or sold with a limit order, they had to sit through this pullback. So that's another example of higher probability to sell below the bar. Now, obviously, it's still okay to sell that close because you can sell higher and manage the trade, exit at the low close. But it's just another example of having the ability to stay out of those trades if it doesn't trigger. But now here, we're not in the spike phase of the bear trend. We're late in the bear trend, coming after a pullback. So it's consecutive climaxes. Traders can sell here, but they have to be cautious. So if they get a doji or a bull bar, they might look to exit quickly at the low close. Now this bar is the second consecutive big bear bar late in the trend. It's the biggest bar in the last 15 bars. And that might start to signal exhaustion. So I think that's getting dangerous to sell this low and after a bigger bar late in the trend. Similar situation here. We have a really tight bull channel and we get a bigger bar here on 28. It looks like a really good trend bar in a bull trend, but it's happening late, possible climax. So not necessarily a good buy, probably a little bit too late to be buying, maybe a small second leg up, but possible climax. So something to watch out for if buying that high after a big bar in a bull trend. So here's one more example. We have a really big bear bar here. And this type of unusually large bear trend bar represents extraordinary selling. And so it begs the question, why is everyone selling so aggressively so late in the trend? Normally you'd expect strong bears to be selling high at a premium because they get the best price to sell up here. So if there's a large trend bar late in a trend, it's usually a combination of weak bulls who are finally giving up. So bulls who bought all the way down, they're finally all just dumping and giving up. It's a combination of them and also weak bears finally selling. So bears didn't sell here, they didn't sell here, but eventually they thought that they're going to miss the trend and they all pile in, start selling here. So it's all the weak traders that are creating this momentum down. And strong bulls here are waiting to buy down here, and so it's creating a vacuum effect. And strong bears are waiting to take profits. So they're waiting for this same level, an important level, in this case it was a trend line, to take profits. And when the strong traders are waiting, it creates a vacuum, and that creates a larger trend bar. And so if the market runs out of sellers down here, because everyone's already sold, all the weak traders have already sold out of their longs and sold into shorts, there are only strong traders left to buy, to take profits, and to initiate longs. And that's why we get a quick bounce after this climax. So here's another example. Late in a bull trend, strong bull trend bar, probably not much left to the upside. Now another common area to see examples of big trend bars that are actually opposite signals are in well-defined trading range days. If there's a clearly defined trading range and you get a two-legged move up, breaking above the top of the range, that ends in a big bull bar like this, a bull trend bar, some traders will sell the close and bet that the breakout will fail out of the trading range because most breakouts do fail. And so this bull trend bar is not something to be bought, but actually something to be cautious of and maybe something to sell if the context fits. This is very common in trading ranges because the market is always surging to extremes and trapping traders in the wrong side. So here we are in a well-defined trading range, and we get this surge to the upside. It's two legs up and surge up, not a good buy, and many traders will sell. Even to the downside, we have consecutive climaxes down, so we're surging to the bottom, surging to the top. All these big bars don't mean much in the context of a trading range, and actually might be signs to look for the opposite direction. So here again, we're in a defined trading range, getting big bars at the top, and then a really big climax sell-off at the bottom, and bulls will actually buy here, betting that we have prior bull strength, a climax down to the low of a trading range, And most traders, most strong bulls, will be betting that this breakout will fail, which it did. And they bet on a pullback for at least a couple legs. So the final section in trend bars is shaved tops and bottoms. Now, shaved tops and bottoms are the strongest versions of trend bars. So you can see here we have a shaved top. It means that the bulls own the bar right until the last second of the bar. And so when you have a shaved top, like we have on 28 as well, we have a shaved bottom and shaved top, it means the bulls are owning the entire bar. And so that's usually a good buy in a bull trend when the context is right. Now here's another example. We have a strong bull bar. Now you could argue that this is a climax and not worth buying. And so I think it would be okay to let that one go. Then we get 25 consecutive bull bars. That is going to attract more bulls. And then 26 shaved bottom, shaved top. A lot of bulls are buying that, at least for a scalp, especially with the measured move target a little bit higher. And that's where we stalled. Here on bar 3, shaved top, shaved bottom. Bears sell below that. And this was last year. I sold there and exited really quickly, but it's a reasonable sell for a swing down trend from the open bear trend. And a lot of bears who sold there, they could either hold for a swing or they can wait for a bar in the opposite direction, like 8, and then exit at the low close. But that is a good signal in the bear's potential trend from the open bear spike phase of the trend to sell below that bar. And one thing Al mentions to be careful of with shaved tops and bottoms is that a shaved top at the top of a trading range is not worth buying because we shouldn't be buying near the high of a trading range. And so the odds of a failed breakout in a trading range are much higher. And also another time to be careful of shaved tops and bottoms are when we have an illiquid market, because shaved tops and bottoms are very common in illiquid markets. And so that's caused by a lack of volume rather than enthusiasm by one side or the other. So in normal markets, if we're trading the E-mini or major stocks, it's usually okay to see shaved tops and bottoms and see them as positive signs. But in trading ranges and in illiquid markets, it's better to be cautious about them. Now I'm going to talk about 2-bar reversals and their variations. The strongest moves usually begin with a reversal bar or a 2-bar reversal. So I'm going to talk about the long side, the short side, and how these setups trigger. So here we have a double bottom bull flag and a wedge bull flag and a 2-bar reversal. And this 2-bar reversal is created by a bear breakout attempt immediately followed by a bull breakout attempt. And so these 2 bars form a 2-bar reversal. The textbook trigger for a 2-bar reversal is above the higher of the 2 bars for the bull case. So if a bull is looking to buy this 2-bar reversal, the textbook buy is above the higher of the 2 bars, in this case, above the bear bar. Now, something I think worth mentioning is that as a trader becomes more experienced, they can start to break this rule and buy above the bull bar. When they have a good sense of the context and they know that the likely direction is up and they're just waiting for a failed breakout and a bull bar closing on its high to buy above. I think when a trader becomes more experienced and they get a sense of when that is the right course of action, they can start buying above the bull bar. But as I'll show in a little bit, there are a lot of examples where when the context isn't great, sometimes the bar won't go above the higher of the 2 bars, and it'll keep beginner traders and intermediate traders out of a bad trade if they follow the textbook rules. So I think a trader should follow these textbook rules until they have a really good grasp and really good sense of confidence about context, and they have proven to themselves that they can break the rules. And until then, I think traders should follow these textbook rules. So in this case, the textbook buy is above the bear bar, the higher of the 2 bars. Here's an example of the bear case. We have a really tight channel up, consecutive climaxes up, followed by a tight trading range, which could act as a final flag. And then we get a bull breakout followed by a bear breakout. This is a 2-bar reversal. Bears will sell below the lower of the 2 bars. In this case, the low of the bull bar and the low of the bear bar are the exact same price. So they'll sell below the low of the bear bar. So a 2-bar reversal is a part of every reversal, but it may not be apparent on our time frame. And every 2-bar reversal is a reversal bar on a higher time frame, and every reversal bar is a 2-bar reversal on a lower time frame. So you can see here we have a reversal bar on the 10-minute chart. If you look at the 5-minute chart, you'll see a bear breakout and a bull breakout. You'll see the 2-bar reversal. But on the 5-minute chart, if you see a 2-bar reversal, it's not necessarily true that if you go to the 10-minute chart, you'll see a reversal bar, because it depends on the timing of the bars. So for example, here on the 5-minute chart, if this bear bar happens at 10 o'clock and ends at 10:05, and then the bull bar starts at 10:05 and ends at 10:10, then from 10 to 10:10 is one 10-minute bar. And so in that case, if it starts at 10 o'clock and ends at 10:10, the 10-minute chart will show a perfect reversal bar. However, if the 5-minute chart has a doji at 10 o'clock and then a bear breakout at 10:05 ending at 10:10, then the 10-minute chart will have just a bear bar as a 10-minute bar. It won't have a 2-bar reversal yet, even though this third bar is a bull bar. On the 10-minute chart, it'll just be forming, and so we won't have a perfect reversal bar on the 10-minute chart in this case. And so traders who are looking at higher time frames, looking for this one perfect reversal bar, may not find it because it depends on the timings. And so what Al recommends is that it's much better to just understand what's happening in front of you and know that this is a 2-bar reversal and it's worth buying above, and this is a 2-bar reversal, it's worth buying above, and not to hope to find this perfect reversal bar on a higher time frame. Now, that being said, he does mention that if a setup is forming on the 10-minute or 15-minute chart with a perfect signal bar, it could add fuel to the move if traders on other time frames are seeing the same thing. And so if they're seeing a clear pattern on their time frame, it might give you more confidence to hold for a bigger target. But that shouldn't be the primary goal for a trader. Primary goal for a trader should be to understand exactly what's in front of them on their time frame and trade that well. I'm going to show some examples of 2-bar reversals in a bull flag context, in climaxes, and opening reversals, in tight channel pullbacks, and major trend reversals. So I'm going to show 1 or 2 examples of each just to get a sense of what a 2-bar reversal looks like in different contexts. So here we have a 2-bar reversal, bar 6 and 7. It's an opening reversal. It's a high to a bull flag. And in this case, we have bar 6, which is a bear breakout of this tight trading range. And bar 7 is a bull breakout. So we have a bear breakout, then a bull breakout. It's a 2-bar reversal. Some bulls will buy above the higher of the 2 bars, which is the official trigger. So they'll buy above bar 7. Some bulls will wait for a second consecutive bull bar, which we get on bar 8, and they'll buy above that. And you can see that ended up being the low of the day. Here we have a bull flag example. We have a strong bull trend staying above the moving average for over 50 bars. And then we get a triangle, a trading range, a bear breakout on bar 69, and then a bull breakout on bar 70. That's a 2-bar reversal. The official entry is above the higher of the 2 bars. In this case, it's above the bear bar, and that doesn't trigger until bar 72. So some bulls can keep their order above bar 69 and wait to get filled, or once they see this bear doji, they can pull it and then wait for 72 to close on its high and then buy above that. And that's a high probability buy for a test of the high of day after a really strong bull trend, staying above the moving average. This is a moving average gap bar setup. Here's an example of a 2-bar reversal in a climax setting. So we have big up, big down. On the way down, we have 3 clear pushes. We have a wedge bull flag, failed, got a strong bear breakout, pause, another strong bear breakout. That's consecutive bear climaxes in what's likely going to be a trading range. Here on this bar, we have a tail below and a strong reversal up. This could be considered to be a reversal bar, but Al mentions, and I'll mention it later, that when you have a reversal bar as the second of the 2-bar reversal, as a second bar in a 2-bar reversal, if it overlaps more than 75% of the prior bar, it's better to treat it as a 2-bar reversal. And so here, it looks like a reversal bar, but because there's so much overlap, it's better to treat it as a 2-bar reversal, and the official entry, the textbook entry, is above the higher of the 2 bars, in this case, above the bear bar. Now, this is a prime example of a more experienced trader sees a micro double bottom and sees a really good bull bar closing on its high. They're waiting to buy at the bottom of a potential trading range. And so an experienced trader might just buy above the bull bar. And I'm pretty sure Al did buy above the bull bar on this day. But again, just to follow the official rules until we're ready to break them, the official entry is above the bear bar. Here, I mentioned this earlier. This is a final flag, bull breakout, bear breakout, 2-bar reversal after a bull climax, after a final flag. Here we have a 2-bar reversal. It's a wedge bear flag. So a gap down, 3 pushes up on bar 1, 4, and 10. We get a 2-bar reversal. and the sell is below the bear bar. It's coming after two strong bull bars, so if a bear sells below there, they have to be looking for a swing, which they did get. And here we have a type of opening reversal, a wedge bull flag, coming after a final flag. We have a bear breakout of the tight trading range, and then a bull breakout. So a possible final flag, possible reversal up from the bottom of a trading range. And some bulls will buy above that bull bar. Some bulls will wait for a second consecutive bull bar and then buy the close of that bar or buy above it. So, but this is the 2-bar reversal, and the official entry is above the bull bar in this case, because the bull bar is the higher of the 2 bars. Here is a parabolic wedge opening reversal to the moving average. We have a bear bar and a bull bar. So bear breakout, bull breakout. Bulls can buy above the bull bar. Official entry is above the bear bar because the bear bar is the higher of the 2 entries. The higher of the 2 bars. And in this case, I say experienced traders can buy above the bull bar. In this case, Al did buy above bar 11. He didn't buy above bar 10. 3 pushes down, tested the moving average. He said this is the easiest trade all day, buying above bar 11. Here's an example of a tight channel pullback. So we have a double bottom bull flag, we have a tight bull flag, a moving average gap bar, and this is a tight channel breakout. We get a bear bar, so bear breakout, bull breakout. This is a bear trap. Some bulls will buy above the bull bar, which is the 2-bar reversal. Some will wait for a breakout pullback, and they'll buy above that bull bar there. Here's an example of a 2-bar reversal in a major trend reversal. So we have the break above the trend line and a break above the moving average, and then a test of the extreme. So here we have a 2-bar reversal, but it does not go above the bear bar. So bulls who bought above the bull bar, they would have to sit through a pullback, and it was pretty close, maybe a tick away from stopping them out if they had their stop below there. Whereas a bull who is following the strict rules would have their entry above the bear bar, and they wouldn't get filled there. Then 2 bars later, we have a micro double bottom and a second entry buy. That is a 2-bar reversal and a second entry at the bottom of a potential trading range, and that's a reasonable buy for a 2-bar reversal. Now, Al did buy above 65, but he exited during 67 for a small loss. So it's a reasonable entry. An experienced trader can exit quickly if they're disappointed. An intermediate or beginner trader might take a full loss, but it is a reasonable entry to buy above 65. Again, above 72. It's a reasonable buy above 72. It's a micro double bottom, second entry buy. Al also did buy above 72, but he somehow made a profit. He exited as 73 was coming down. And this is an example of experienced management. It's something that not all traders can do. Intermediate traders and beginner traders can't do it. But I'm just pointing out the reasonable trades for 2-bar reversals. And over time, as traders become more experienced, they can see the clues that it's not working as planned. And in this case, we're buying high in a tight trading range, and it ended up being a bear flag, but we didn't know that at the time. It could be a reasonable buy. But when it shows signs that it's actually turning into a tight trading range bear flag, experienced traders like Al can exit early. We may have to take the full loss. So now I'll talk about the nuances of a 2-bar reversal. So one nuance is a good practice is to look for any trend bar that's followed by an opposite trend bar within 10 bars. So look for any trend bar or a set of trend bars that are followed by either one big trend bar or a set of trend bars in the opposite direction, even if they're separated by many bars in between, because that's a 2-bar reversal on a higher time frame. And so here we have bar 7, 8, 9, 10, strong bull move up, especially bar 9 and 10, strong trend bars up. We go sideways for 10 bars, and then we get a big bear bar 25. So we have big up, sideways, big down. On a higher time frame, that's a 2-bar reversal. And here we have bar 11, big trend bar up, 3 bars sideways, and then bar 15. That's a 2-bar reversal. Now, just because it's a 2-bar reversal doesn't make it a good sell, because it's a very tight channel up. But it still is technically a 2-bar reversal, and traders should see it that way, but not necessarily act on it because the context is not good. Then we have a tight trading range, or a trading range, possible final flag. Then we get a bull breakout, 3 bull bars up, sideways for 7 bars, and then a bear breakout, 2 bear bars. So that is big bull bar, sideways, big bear bar on a higher time frame, on some higher time frame, and should be seen as a type of 2-bar reversal. And after a final flag, the context may be good to start looking for sells. Second nuance is that a reversal bar can be the second bar in the 2-bar reversal. So I mentioned that earlier, that the reversal bar can be the second bar in the reversal, but if it overlaps more than 75% of the prior bar, it's better to treat it as a 2-bar reversal. And so here, we have a tail below, it triggers below the prior bar, looks something like a reversal bar, but because it overlaps so much of the prior bar, it's better to treat it as a 2-bar reversal. Now, if we treat it as a 2-bar reversal, then the official textbook entry is above the higher of the 2 bars, which is above bar 11. Now you can see that I bought above bar 12, and I ended up getting stopped out below bar 12, so I lost 10 points there. Had I followed the official entry, I wouldn't have been filled, and I would have saved 10 points. And so now when I see this chart, I see a spike down on bar 8, and I think we could get a more meaningful second leg down from 8. Here I thought it was 11, and I looked to buy. Now I would look at it and see 8 and think we're going to get something like bar 16. I would think of a more meaningful second leg down than this one. But when you don't know that and you don't have a sense that that could be what's happening, then that textbook rule will keep you out of these bad trades because many times it won't go above the higher of the 2 bars and you'll be saved, in this case, 10 points by using the official entry. And here's another example. We have a tight channel down, a lot of bear bars in a row. Then we have a bear breakout followed by a bull breakout. It's a 2-bar reversal. Now, traders who buy above 18 thinking it's a 2-bar reversal, if they buy above the bull bar, the context is not good necessarily. It's probably going to need a second entry after the tight channel down. So someone who's looking at context, they're not even looking to buy yet. They're looking to buy after a breakout, minor breakout, and a test down. But someone who's looking at patterns, they might see a 2-bar reversal and buy above 18, and they'll get trapped into a trade and get stopped out. If they follow the textbook entry above the bear bar, they can avoid a loss. So even if your read of the context is not very sharp, by following the textbook rule, you can stay out of a lot of these trades, because a lot of times the market will save you if you look to buy above the higher of the 2 bars. Now in this case, even if it went above the higher of the 2 bars, it's still not a good buy because the channel down is tight, and so it's better to wait for a breakout and a pullback to a higher low or lower low. But many times the market will save you if you use the textbook rules, and that's why Al recommends them. The third nuance is if the second bar goes above the prior bar, treat it as an outside bar. And Al says treat it as an outside bar even if the low of the second bar is above the low of the prior bar. So here, for example, the low of this bull bar is above the low of the bear bar. So it's a 2-bar reversal, bear breakout, bull breakout. But Al says because it's going above the prior bar, and in this case going far above the prior bar, it's better to treat it as an outside bar, even though it's not technically an outside bar. And in this case, it's better to wait for a higher low pullback before buying. Because remember, we're looking for an imbalance of buyers and sellers. And so even though this is a 2-bar breakout, even though it's a 2-bar reversal, a bear breakout followed by a bull breakout, sometimes when that happens, it's a magnet, a vacuum test to a level of resistance. In this case, the apex of the triangle. And so yes, it's a sign of strength, bear breakout, bull breakout. But now it's forcing traders to buy in the middle of a triangle, at the apex of a triangle, which could be the target. So it's better to see more evidence of the bulls showing up in the form of a higher low, and then look to buy. So here's another example. The second bar is above the low of the prior bar. It's a 2-bar reversal, but Al says treat it like an outside bar. And so instead of buying above this bar, it's better to wait for a higher low pullback, because this is a trading range. It's a tight channel down. It's the first breakout. It may be forcing traders to buy in the middle of a trading range. So better to wait for more evidence of a higher low and then look to buy. A trader can buy a higher low with a limit order, or can look for a bull bar closing near its high, or can buy above the entire pullback. So once we get the strong bull bar, wait for the pullback to start and then buy above the entire pullback. Here's another example. I have a lot of examples saved here just because I was noticing them a lot after reading the chapter, and I saved them all here just to have them all in one place. So they're all here, so just bear with me for a couple more. So here we have a strong bear breakout below the trading range, and then a bull breakout. It's a higher low. So this low is higher than that one, but still treated as an outside bar. So don't buy above that, forcing traders to buy after 4 bear bars and potentially in the middle of a trading range at the open of the day. Better to wait for a higher low pullback and buy above 31 or buy above the entire pullback. Here's another example. treat it as an outside bar. Now at some point we get a bull bar, a second consecutive bull bar, and then a doji. So 2 consecutive closes above this prior lower high, above the neckline of the double bottom. At some point, traders will conclude that we're not going to get the higher low pullback, and they'll start buying above bars. They might buy above 13 after the second consecutive bull bar, or start buying closes. Here's an example of the bear case. We have a bull breakout, bear breakout. Here it's forcing traders to buy at support, the trend line. I did sell below 47, but this went below the prior bar. It's a big bear bar, so big risk. It's forcing traders to buy at support. Better to wait for a lower high. So I was thinking wedge bear flag, but if I followed the official rules, I shouldn't have entered below 47. I should have waited for a lower high, and I would have avoided a loss. Instead, I sold below 47, I exited above here, and lost 10 points. The final nuance is a special type of 2-bar reversal. Al says when you have a 2-bar reversal that's for the bear side, in the bear case, if you have a 2-bar reversal that's sitting below the moving average in a trading range where there's a lot of overlap, it's actually better to do the opposite. So here we have bull bar up, so bull breakout up on bar 2, what Al has labeled as bar 2. This is a chart from the book. And then you have a bear breakout. That's a bull breakout, bear breakout, 2-bar reversal. But there's so much overlap, and it's not coming in a strong bear trend. It's coming in a possible trading range. So this is a possible second leg trap for the bears in a bull trend. So here, instead of selling this 2-bar reversal, Al's saying a lot of traders will actually buy below that bar because it's forcing traders to sell low in a tight trading range, which is a bad sell. And that makes it a good buy in this case. It's buying low in this tight trading range. So betting against the bear breakout in a tight trading range. And so bulls will buy that for a scalp. Here's another example. We have a bull bar here, bull breakout, bear breakout, and a lot of overlap below the moving average, not in a strong bear trend. So traders here, instead of selling below this bear bar, they'll actually buy the low. And you can see that a lot of traders did do that, and we couldn't even get below the low of that bar. And so there are a lot of limit orders to buy that low because it's betting against the breakout of a tight trading range. It's a 2-bar breakout. Sorry, it's a 2-bar reversal, but there's so much overlap that it becomes a tight trading range. And then instead of selling, you're buying, betting on a failed breakout. The last section for 2-bar reversals is what to watch out for. And 2 important things to watch out for here are prior strength and overlap. And prior strength is an important thing to watch out for with 2-bar reversals because by definition, a 2-bar reversal has strength in the opposite direction first. So here we have a 2-bar reversal 60-61, and by definition we need a bull breakout first. So we need a bull bar and then a bear bar to form a bearish 2-bar reversal. But it's important to see what's happening before that. And so we're going to have a bull bar and a bear bar, but if it's coming after a lot of bull bars, then yeah, we might have a 2-bar reversal. But it's coming after a lot of bullish momentum. And so it's something to be careful for and to watch out for, that we want to be aware of how much momentum it's coming with. And so here we have 3 really strong bull bars, and that bear bar is forming a 2-bar reversal, but not worth selling because of the context and the prior strength. The other thing to watch out for is overlap. And I've shown this example quite a bit, but here we have a 2-bar reversal, but it's coming after overlapping four consecutive bars. So it's a possible tight trading range. And so by buying up here, we're possibly buying at the high of a tight trading range bear flag. Here is another example. I've shown this as well. We have 2-bar reversals, but they actually end up being double top bear flags, and we're buying high in tight trading ranges. And I mentioned earlier, experienced traders can exit early, but traders that are not at that level have to be aware of the possibility that we could be buying high in tight trading ranges because there's so much overlap. So here we have a 2-bar reversal, but there's 6 bars of overlap. Here it's a 2-bar reversal, but it's 5 bars of overlap. So we could just be buying high in a bear flag in a tight channel. So that's something to be aware of, prior strength and overlap. So I talked about trend bars and 2-bar reversals and variations. I'm going to call it here for part 1 and then leave the next 4 sections for part 2 just so that the video doesn't get too long. So I hope you found it helpful, and please let me know if you have any feedback or a different perspective to share to help with my understanding.